In this lesson, you're going to learn about the second method we can use to calculate terminal value, which is called the Gordon growth method. Now, in contrast to the first one we looked at, the multiples method, where we assume that the company would be sold after a period of time, usually at the end of year 5, as in this analysis. With the Gordon growth method, by contrast, we're assuming that the company keeps operating indefinitely, and that over time, its cash flows, the cash flow growth it experiences, will slow down to relatively the same percentage or a percentage in the same range each year, and that we can then value the company based on its cash flows indefinitely into the future. So what we're going to have to do here to complete this analysis is first to assume a terminal growth rate. We're going to need that because we need to figure out how much the company's cash flows are actually growing into the future. Then once we have that, we can calculate the terminal value using a slightly different formula here, then figure out the present value once again, and get to our enterprise value for the company here. So first off, when we think about the proper terminal growth rate to use here, what we should really do is look at the company's existing free cash flow growth rate and base it on that. So let's go down here and start calculating the free cash flow growth rate each year. I'm going to start with 2011 because that's what's displayed on our DCF. We don't have data from before 2010, at least on this page. So I'm going to take our numbers here and just divide by the previous one and subtract 1 each year to get the percentage growth rate. Copy this across. So we see here that free cash flows overall are growing by over 10% initially and then slow down to around 5%. So it would be unrealistic to assume anything much greater than 5% here. And in fact, most of the time in a DCF analysis, when you use this method, you generally assume something very conservative for the long-term growth rate of the company. Usually something close to the GDP growth rate or something close to the rate of inflation, for example, might be used here. Now, if you're working in a market that's growing much faster, so if you're in a country that is developing quickly, the GDP growth is much greater than 5%, maybe it's 10%, even higher than that, then maybe you would use something more aggressive here. But most of the time for mature companies in developed economies, use something very low for the terminal growth rate. So in this case, we're going to go with an assumption of 3% for the terminal growth rate, which really means how much will the company's free cash flows grow indefinitely into the future each year. Now, as with the terminal EBITDA multiple, it's not just the 3% that we're going to be looking at. We're actually going to be looking at a range of values around this 3%, which you can see with our tables, our sensitivity tables right here. So we're going to be looking at a range, but this is our baseline assumption for this analysis. The other thing we want to do here is add in a switch up at the top for whether we use the multiples method or the Gordon growth rate method. The reason for that is we want to give whoever's looking at this model the option to use either one when they're going through it. So I've already used something called data validation here, which you can access with Alt-DL to make sure that it's always 0 or 1. I'm going to enter 0 here. So we're saying that we do not want to use the multiples method. If we entered 1, we'd be saying that we are using the multiples method. I'm going to keep it at 0 for now. And now let's go in and think about this terminal value formula. So we have to change this around, and we have to say now that if we are using the multiples method, then it's just the same formula we looked at before. But if we're not using it, then it's going to have to be something different. So what we're going to have to do in this case is if we're not using the multiples method, we have to calculate the company's value based on its free cash flows growing indefinitely here. So what we're going to do is take our unlevered free cash flow in year 5, multiply by 1 plus the long-term growth rate here. Then we're going to divide by the discount rate minus the terminal growth rate. So the way to think about this formula intuitively is that we're looking at how much the company is growing by each year into the future, and then we're dividing by the expectations of that growth into the future. So the investors are expecting a certain return, this discount rate, and so we're dividing by their expectation minus how much the company is actually projected to grow. And we're using that to assess what its value might be indefinitely into the future. So we're really looking at how much the company is really going to grow divided by the expectations of how much it's going to grow, and we're using that to arrive at the value here. Now, the actual definition, according to corporate finance theory, may be a lot different from that and maybe more formal, but that's just how I think about this formula and what we do here. We can see that our terminal value is much higher with the free cash flow growth method here. That does not indicate that the value using this method is always going to be higher. That just happens to be the case here. The other thing we want to do here is modify our present value of terminal value formula. And the problem here, the reason why we need to modify this is because remember that we're using the mid-year discount convention. Since we're using the mid-year discount convention, we don't want to be assuming 1, 2, 3, 4, 5 for the discount periods. We want to be assuming instead that the cash flow arrives to us throughout the course of the year, and so we want to be discounting by this 4.5 instead. This is a subtle point, but it's important to get this right because, as you'll see, even a small difference here can actually have a substantial impact on the terminal value. So let's change this, and the formula is almost the same, but we're going to just add something in and say, if we're using the multiples method, then we're going to use this formula. Otherwise, instead of the J24, we're going to use J25. We see now that our present value has actually jumped by around 5 billion or so here. So a decent difference considering it's only a difference of 0.5 in terms of our discount period. So that's one final subtle point you want to keep in mind when choosing between these methods. And then if you're using the mid-year discount convention, something else that's important to keep in mind here. So that's how we use the Gordon growth method to determine terminal value for a company like Apple. Coming up in the next lesson, we're going to be looking at Apple's implied price per share based on these methodologies, and then we'll be looking at some sensitivities around that. Because remember, we can't just assume 7 times or 3% here. We always want to look at a range of values. And so we're going to be setting up sensitivity tables to do exactly that and look at a range of different per share prices here rather than just sticking to the fixed numbers that we have here right now.